Good afternoon, this is Sean Golding with Golding & Golding, here to do a little basic introduction for taxpayers who are considered U.S. persons and living overseas abroad in a foreign country. How the U.S. tax system works, how it impacts them, and what they should be aware of, exceptions, limitations, things of that nature. So the basics of the U.S. tax system. Who files and pays U.S. taxes? Well, we're talking about taxes on worldwide income. Anyone may have to pay tax even if they're a non-resident if they have U.S. sourced income. But for taxpayers who are considered U.S. citizens, lawful permanent residents, foreign nationals who meet the substantial presence test, then you have to include your worldwide income on your tax filings as well as your foreign account asset reporting, FBAR, FATCA, things of that nature. Now, some taxpayers who live in a treaty country, they may qualify for a treaty election. They may meet the substantial presence test, but meet an exception like the closer connection exception or a different exception. But from a baseline perspective, those are the main three categories of individuals. People who expatriated and they were covered, they may have an ongoing tax implication depending on when they expatriated, if they're giving gifts to U.S. persons, things of that nature. Accidental Americans, of course, may not consider themselves to be Americans or U.S. citizens, but from a tax component, they're still required to report their worldwide income, foreign assets, even if all of their income is sourced from overseas and they've never stepped foot in the United States. For taxpayers who have foreign income, they may qualify for things such as the foreign earned income exclusion, foreign tax credits. This may work to reduce or eliminate U.S. tax liability, but it doesn't eliminate the requirement to file. If you qualify for the foreign earned income exclusion, you file your return with a 2555. If you qualify for foreign tax credits, you file your return with a 1116, and you may have to file both depending on what your income looks like overseas. Again, there's various exceptions, exclusions, limitations from a baseline. Those are the people that have to file U.S. tax returns each year, even if they live overseas, even if all of their income is sourced abroad. So the worldwide income from a U.S. component and the reporting operates differently than other countries. Most countries have worldwide income and worldwide reporting, but it's mainly for people who live in that country for at least 6 months in a day. If you live in a foreign country, let's say 9 months out of the year, then that country will typically tax you on your worldwide income, not income just sourced from that country. From a U.S. component, it's a little bit different. If you're a U.S. citizen, let's say, you could live in a foreign country, earn all of your income from foreign sources, not step foot in the United States during the entire year, still got to include that income on your U.S. tax return. Now, compounding the misery is the fact that not only do you have to report your worldwide income, but you also have to report global assets, bank accounts, stock accounts, investment accounts, foreign pension plans, life insurance policies, foreign partnerships, foreign trusts, foreign entities, things of that nature. These are all reportable, and they're reported on different forms. So the FBAR, the Form 8938, 5471, 3520, 8621, etc., etc. Some important things to note is when you file an extension for your tax return, some forms may go on extension, like the 5471 or 3520. Other forms may not, such as the 3520A as an atom. Different forms have different due dates. They have different mechanisms in order to obtain an extension. So it's important to keep all this in mind because when you file late forms, the IRS loves to penalize you. There's various amnesty programs you may be eligible to avoid, minimize penalties we'll get to in a moment, but from a baseline perspective, again, the IRS likes to penalize, so it's important to know the different asset categories, what forms these asset categories are reported on, what date the forms are due, and what you do to try to get an extension. So here are some other facts that are common when we're dealing with expats and expatriates. First of all, is the difference between being an expat, being an expatriate. The words are interchangeable. They could be used interchangeable, but from a tax perspective, typically an expatriate is someone who has formally renounced their U.S. citizenship or terminated their long-term lawful permanent resident status, or otherwise just have completely given up their status, so they're no longer a U.S. person. An expat is typically just someone who lives overseas. So citizen moves overseas, permanent resident moves overseas. The fact that they live overseas, they might be defined as an expat, but they're still a U.S. person for tax purposes, whereas someone who formally expatriated and terminated their U.S. status is not. They may, If someone's an expatriate, they may still have to pay U.S. tax, or if they're just a non-resident, on U.S. sourced income, but they're not taxed on their worldwide income. Accidental Americans has become a big issue because the IRS likes to penalize. So maybe you were born to a U.S. parents and you moved overseas at a very young age, or you were born overseas to a U.S. parent and you have no connection with the United States. You have no income from the United States, no assets, nothing like that. Haven't even visited the U.S. in 20, 30 years. If you're a U.S. citizen, you're still taxed on your worldwide income, but there's various programs. A specific program is the relief procedures for certain former citizens and other residents. You may qualify for that, but there's very specific thresholds. If you're living overseas and you're not filing your forms and you're not filing your taxes, you think the IRS can't find you. Unfortunately, with FATCA, it's harder to disappear. FATCA is the Foreign Account Tax Compliance Act. More than 110 countries, hundreds of thousands of foreign financial institutions report U.S. taxpayers to the U.S. government. So you may have accounts in a foreign country. That account may earn income. You're thinking, well, how is the U.S. government going to know? But those institutions will report monthly, semi-monthly, quarterly, biannually, annually, whatever. But different institutions report differently depending on how many U.S. Account holders they have. If you're found to have violated these rules and you get penalized, the problem is, it may be hard for the U.S. to come overseas and get your money that you have in a foreign country. I mean, sometimes they can, but that's difficult. But they can do other things. They can take your passport. They can decline to renew it, revoke it. They can issue liens and levies and seizures on your U.S. property. Just because the money's earned overseas doesn't mean they can't go after your U.S. property. So it's important to try to get into compliance if you can before any of this happens. There's a lot of fear-mongering online. A lot of it is asinine. For the most part, there's various safe programs you can use to get into compliance that are developed by the IRS. If you're willful, typically you do the voluntary disclosure program. If you're non-willful, there's the streamlined procedures, delinquency procedures, and reasonable cause. We've got a ton of free information available on our main website and our sub-websites. You can always reach out and schedule a reduced fee initial consultation if it's appropriate to your matter, and it's something that we handle here. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.